Howdy, folks. Welcome to Liberty Call. It is Tuesday, August 15, 2023. Hope everybody's having a good day out there in the interwebs. It's a beautiful day here in Colorado. Not quite as chilly as it was yesterday. It is just perfect. And what's 80 degrees outside? I mean, it's kind of chilly down here in the basement where me and my wife's offices are. We were commenting on that earlier about how it's August and it's already chilly down here again. So anyways, kind of not a good day in the markets. The major indices here domestically are all down more than 1%. But again, if you've been watching and playing along with me all year long, this is not a shock. It's to be expected. But, the morons in TV who are like, oh, yeah, it's a bull market. Everything's good. They're like standing there like, what the hell just happened? So, I mean, they're not all idiots. But anyways. All right. Well, if it's your first time watching Liberty Call, like I said, I'm glad you're here. Thank you very much. If you could, give me some thumbs up, likes, shares, subscribes, follows, hit the notification bell so that you know when I go live. And let's go ahead and jump into the numbers for today. Dow Jones was down 1.02%, 361 points, closed at 34,946. S&P 500 was down 1.12%, closed at 4439. NASDAQ down 1.14%, closed at 13,631. The VIX was up 10.8% today. It's up to 1642. Canada was down 1.93, Brazil down 0.49, and Mexico up 0.56, the lone outlier here in the Americas. Germany was down 0.86%, the UK down 1.57%, France down 1.1%, the Netherlands down 0.9%, Spain down 0.87%, Italy up 0.57%, Switzerland down 1.12%, and Portugal down 0.63%. Russian exchanges were split again today. MOEX down 0.5%, RTSI up 0.08%. And the overnight's a little more green here. In Japan, the Nikkei was up 0.49%, Australia up 0.38%, New Zealand up 0.31%. In China, the Shanghai was flat at down 0.07%, the Shenzhen component down 0.7%, China A50 up 0.19%, DJ Shanghai down 0.2%. Hang Seng down 1.26%, and the Taiwan weighted was up 0.37. All right. So, like I said, kind of an ugly day, but again, to be expected. I think some data, retail sales, I think, came out today and was probably better than expected, which probably hurt the markets today. So, all right, let's go ahead and jump over to the market recap. S&P 500 slips as retail sales. Upside surprise, dents, dovish Fed bets. All right, the S&P 500 experienced a downturn on Tuesday due to indications of unexpectedly robust consumer spending, dampening hopes of a prolonged pause in Federal Reserve rate hikes. Retail sales took a surprising leap of 0.7% the previous month, surpassing the anticipated 0.4% and marking the most substantial surge since January. This unexpected sign of consumer strength tempered assumptions that the Federal Reserve might delay rate hikes later in the year. Their next meeting is September 19th and 20th, so about a month from now. Where was I? This unexpected delay rate. Okay. Consequently, projections for a potential rate cuts have been pushed further into the future. The likelihood of a Fed rate hike in November escalated from 26.4 to 32.2, as reported by the CME FedWatch tool. However, some experts on Wall Street anticipate the consumers' spending capacity to decline sooner rather than later. Morgan Stanley noted that a weakened retail sales trend is expected throughout the year's end, potentially influenced by credit availability's impact on economic activity and the labor market. Amidst the economic fluctuations, banking stocks encountered a stumble as Fitch Ratings cautioned about a possible downgrade. The credit ratings agency revealed the likelihood of a downgrade of several U.S. banks, including major institutions like J.P. Morgan, should the health of the U.S. banking sector deteriorate further. This could necessitate a reevaluation of ratings for over 70 U.S. banks that Fitch covers. As a result, regional banks like Citizens Financial Group, KeyCorp, and M&T Bank were the primary casualties in the sector, with major Wall Street banks such as J.P. Morgan and Bank of America also dropping over 2%. Let's see here. Discover Financial Services also saw a significant decline of over 10% after the resignation of CEO Roger Hochschild child. Home Depot reported better than expected quarterly results, yet the company's cautious outlook on diminishing demand for big-ticket discretionary items cast a shadow on the positive news. Despite the slightly improved stock performance, concerns about consumer demand weighed heavily. NVIDIA Corporation continued its upward trajectory, gaining more than 1% following positive endorsements from UBS, Wells Fargo, and Baird, which raised their price targets for the chipmaker due to optimism regarding AI-driven demand. NVIDIA's allure also extended to the Middle East, with reports suggesting significant purchases of its high-performance chips by Saudi Arabia and the UAE. On the flip side, PayPal Holdings faced a decline of over 4% after Elliott Investment Management revealed the sale of its stake in the company during Q2. This move was indicated in a U.S. Securities and Exchange Commission filing. Meanwhile, Paramount Global climbed 3% as talks between Hollywood Studios and the Writers Guild of America showed potential signs of progress in resolving the lengthy strike by screenwriters. Oh no, TV is going to just not be the same. Hollywood Studios offered concessions on key issues such as artificial intelligence usage and access to viewer data, according to reports. Yeah, if I could stop here. Some scuttlebutt I heard recently was that a lot of the writers want royalties on, and basically anyone of the behind the scenes people, they want royalties for their time that they put in on, a TV show and every time it's watched through the streaming services. And from what to get to my point here, what I've heard is that the streaming services are not willing to share their user data, probably because, and this was the speculation on the person I was listening to's part, is that they're not getting the viewership that, they're telling everybody. And, if they're going to pay people out on, well, if you watch, whatever, Seinfeld season 1, episode 1, I get paid $1 for every time, someone watches it on Netflix. If they've been overestimating their viewer rates, then, they may have to have some egg on their face later on. All right, jumping back in to finish this up. In a complex landscape of market movements, the interplay of economic indicators, corporate earnings, and investor sentiment continues to shape the trajectory of the financial markets. All right, so what was this? What did we also talk about further? I know they were talking about wanting to drop rates. I know that's a big push that the people in the financial journalists have been talking about a lot. People on TV, when are we going to lower rates? I know everyone would like lower interest rates, whether or not you're buying cars, houses, stuff like that. But, we need to get some financial stability before we really start going down that road. All right, up next, Social Security retirees can face a $17,400 cut in 2033. Will Social Security be saved? I would say no, personally. All right, the future of Social Security is riddled with concerns as the program approaches a funding crisis due to the impending depletion of the Old Age and Survivors Insurance Trust Fund. This fund, which provides a substantial portion of Social Security benefits, is projected to be exhausted within a decade. I think I saw 2025 or 7. So that number sticks out in my head. This impending shortfall has sparked worries, with estimates suggesting potential benefit cuts exceeding $17,000 annual for retirees. The report by the Committee for Responsible Federal Budget, that's funny, highlighted that when the OASI fund becomes insolvent, estimated to be around 2033, the average annual benefits for newly retired dual income couples could be slashed by $17,400. The law mandates that after the fund is depleted, benefits can only be dispersed in line with incoming trust fund revenue. This would result in a 23% cut for all 70 million retirees, dependents, and survivors. The extent of these cuts would vary based on income levels. For instance, low-income, dual-income couples retiring in 2033 could face a $10,600 annual reduction, while high-income counterparts might see a $23,000 decrease. It is crucial to note that these cuts, while significant, could mean the end of Social Security itself. The program mainly relies on payroll taxes and is expected to sustain over 75% of current benefits, even without OASI funding. However, policymakers have proposed several solutions to address the issue. Number one, and we can get to that. That's right here. Number one, tax adjustments. Some lawmakers suggest raising the income threshold subject to Social Security Social Security payroll taxes. The current cap is set at $162,200. Elevating it to $250,000 or higher could generate additional revenue. They just waste it. Retirement age. Increasing the full retirement age has been proposed, which currently set at 67 for those born in 1960 and later. Raising it to 69 or 70 could render more workers ineligible for full benefits, thereby slowing the trust fund depletion. Universal benefit reduction. Although a politically unpopular option, some policymakers have indicated that overall benefits might need to be reduced to address budgetary concerns. Yeah, because inflation hasn't been out of control the last few years, and really for the last 2 decades. We built up all this inflation by having interest rates at zero for the better part of the last decade. So, hey, they created this problem. They're going to have to figure a way out of it. And last but not least, a payroll tax increase. The current contribution rate for both employees and employers is 6.2% of wages for Social Security funding. And then you add on another 3% for Medicare, split between the employee and the employer. Raising this rate could infuse more funds into the system. Despite these looming challenges, Social Security will persist, albeit with potential adjustments. It's crucial for policymakers to consider various measures to secure its sustainability and prevent undue financial burden on retirees. As the debate unfolds, finding a balanced approach to ensuring the program's longevity while safeguarding retirees' well-being remains a priority. I don't think it is a priority for the people in Washington. I think it's just, they're looting the treasury before the whole system collapses, in my opinion. All right. Last up, this comes from Mises Wire, titled Eurodollars as a Fractional Reserve Market, written by David Brady Jr. Let's see what he has to say. All right. Austrian economics offers a comprehensive perspective on the mechanics of credit creation by commercial banks. This insight includes the recognition of how banks can generate money by creating credit, a process where they issue money substitutes beyond their depositor liabilities. However, an unexplored area within this framework is the influence of non-bank or foreign financial institutions on credit creation and its wider implications for economic cycles. For instance, consider the scenario involving a bank like Deutsche Bank. While its U.S. branch is bound by Federal Reserve regulations, its London counterpart faces no such restrictions on holding U.S. dollar deposits. Consequently, foreign branches can issue credit without legal constraints, essentially operating as unregulated credit creators. This parallels non-bank entities, both foreign and domestic, which function similarly in issuing credit. Therefore, the distinction between the shadow banking system, and that's in quotes, and the Eurodollar markets becomes irrelevant when analyzing credit creation dynamics. This perspective questions the conventional money multiplier equation, where the reserve ratio is the denominator. Hang on a second. Where the reserve ratio is the denominator, non-bank entities might maintain minimal reserves as low as 1% and exploit this exponentially expand credit and exploit this to exponentially expand credit. That's a mouthful. This expansion can lead to significant economic repercussions. This unchecked credit enters the market, artificially depressing the interest rate, which prompts businesses to engage in longer, riskier production processes. This in turn fuels economic booms that eventually culminate in a bust that as unsustainable investments unravel due to rising interest rates and credit contractions. Moreover, these non-bank entities can subject consumers to potential risks. Lacking the protection of institutions like the Federal Deposit Insurance Corporation, these entities might struggle in cases of bank runs or similar crises. The subprime mortgage crisis of 2008 exemplifies this, with non-banks offering risky loans that ultimately destabilize larger financial institutions. The Eurodollar system, which involves dollar deposits in foreign banks, presents an often ignored facet of credit creation. It is important to recognize that the size of the system can be substantial, even surpassing the domestic banking sector in some cases. For instance, the U.S. shadow banking system encompassing such credit creation reached around 194% of the country's GDP in 2021. In conclusion, Austrian economics provides a holistic comprehension of credit creation by commercial banks. Nevertheless, the role of non-bank and foreign financial institutions in shaping credit dynamics deserves greater attention. Their unregulated credit issuance and its potential impact on economic cycles emphasizes the need for a comprehensive understanding of the entire credit landscape. And I'm sure they're not talking about more regulation, because all these people are libertarians and they don't like regulations at all. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. It's right down here. Right there's my email address. You can drop me a phone call, shoot me an email, or book a meeting, whatever you'd like. So, Hope everyone has a wonderful evening, and I will talk to you next time. Adios.